Welcome to the StockOdds podcast. I'm your host, Stephen Noble. Our listeners know that trading is challenging. They want ideas. They want to know when and how to hedge. They want to increase performance and lower risk at the same time. We answer those requests by focusing on the odds of the trading game. Operate like the casino, not the uninformed player. Trade with a positive expectation and insulate yourself from those blind sides the market whacks traders with. Today we're here with my co-host Rob Friesian and Dennis Dick. Dennis is a proprietary trader and market structure consultant with Bright Trading LLC. He has 20 years of proprietary trading experience specializing in pair trading, crutch trading, momentum, contrarian, technical, and algorithmic trading. His insights into equity market structure have been cited in a number of financial publications, including the Wall Street Journal, Reuters, Dow Jones, and Forbes. Dennis is a regular contributor to CFA magazine and a member of the Capital Markets Policy Council at the CFA Institute. He holds his business degree from the University of Windsor with a concentration in finance and economics. He is the host of the Benzinga Pre-Market Morning Show, premarket.benzinga.com. How are you doing today, Dennis?
I'm doing great. How are you doing?
I'm doing good. Today's been a good day so far. So Dennis, what was your first stock trade?
What my first stock trade, actually, so we go back all the way to 1995. It was the time when the internet was just getting started, and you saw these newsletters, and that people would publish newsletters. And I can remember a newsletter coming out with this Net Nanny software, and the internet was just getting started. And this would have been back on the Vancouver Stock Exchange. So we all start with penny stocks, right? So this Net Nanny software was going to be the software that protected your kids from surfing around and finding inappropriate things on the internet. And I remember the symbol was NNS on the Vancouver Stock Exchange. And I bought it around $1 off of this newsletter recommendation. And wouldn't you know, always your first trade, and with that, you get attracted to the stock market, it's a winner. And the thing went up to $3 in about 3 weeks. And I was like, this is the easiest thing in the whole world. I'm like, why am I not just, this stock market, this is the way to do this. And I had another friend that was involved with that as well. And we were just, shocked at how quickly you can make money. So if I would have lost on that first penny stock, I probably would have been turned off the stock market and maybe had a whole different path, a career path here. But I made money on my first penny stock. And that's really what attracted me into the stock market. So that would have been just at the beginning of university.
Yeah, I had a very similar experience back in 2012, 2013, and that's what got me going in the markets. But as with the penny stock markets, the first one's always the win, right?
The first one hooks you in. It's like the casino; they got to reel you in.
So, what were your previous work experiences before you made that first trade that sucked you in?
Believe it or not, I did construction. My dad and my uncle owned a construction company together for 50 years, for a long time. And I started working construction with them as a kid, like 10, 11, 12 years old, just working on the sites. And as I got older, I learned a lot from my father, learned a lot from my uncle. And we continued to, I just was working construction. And I did that during the summers and after school, probably until I was about 22 years old when I graduated from university. And when I graduated from university, I was like, I don't want to work construction. It's not easy work. So I was looking already for something other than that. And I had a friend of a friend, Rashid was my friend, and he had a friend, I believe his name was Alex, and he was trading stocks with this company called Bright Trading, and they had an office in Detroit. I was like, that sounds cool. I had a little bit of retail experience, success trading my parents' money. And obviously I told you the Net Nanny story already. So I was trading retail for about 2 years, just, on the side with my parents' money until, I graduated from university. And then I went over, met Joel Alconin at Bright Trading in Detroit. And a week later I signed up. This was right out of university. I thought, you know what? I'll give this day trading thing a shot. If it works out, I'll stick with it. If it doesn't work out, I'm going to go for my MBA. So I decided to give it a shot, came in, funded my account with the help from my parents. And I've been there ever since. 21 years later, I'm still at Bright Trading.
So what were the early years of trading like for you?
I can tell you my first couple of weeks of trading were interesting. So the first week of trading, I made money, and I was like, oh, I'm good at this. I'm good to go. I made, I think, maybe $200 or $300. We were trading very small size. Bright Trading was always very good. The newer traders would come in, trade 100 shares. Joel O'Connor was an excellent mentor. Trade 100 shares, get used to it. You have a bad trade, you lose 50 bucks, you lose 80 bucks. You'll stay in the game for a long time. Yeah, and so I was trading small size, just 100 share lots. And I can remember the first week, I think I made $200 or $300 the first week, and I was like, I can do this. And then the second week happened. And on the second day of the second week, I lost on 17 consecutive trades. And I think that was the office record. So you think about the odds of losing on 17 consecutive trades, it's like, you're really bad at this. So, and then it took, a good 3 to 6 months before I started to find some consistency in my trading. And, I tried this, I tried that. I had, we were using First Alert back then, which was scanning software, which would look through charts and look for certain setups and patterns. And I would try to trade those patterns. And I'd try, and you'd make a little, lose a little. I wasn't getting anywhere. And then, we were using scanners and we were doing different size. But where I really started to break through was after about 6 months of learning what not to do. I started to realize, what, there's a lot to reading this level 2, reading the book, reading, where the big buyers are, reading, not so much the charts, but reading where the big buyers are and the big sellers are right from the level 2 montage. And once I started to understand and, read that book pressure better, because stocks really trade in waves, they go up and they go down. But, once you can read that, hey, there's buyers in the market for this stock today, I'm going to buy the pullback on that stock. That's where I started to have some success. So it was really when I started to focus on the book, the actual level 2 quotes, that I started to have success. I never had a lot of success with charts. I do use them. I think they're a good tool in your toolbox. There's a lot of traders that focus on charts. I've always just used it. It's never been my primary tool. I respect the charts, but I've always kind of been a book guy.
So when you discovered watching the bids of the book from big buyers, would you say that was your first real edge and you tried to compound it and get really good and consistent with it?
Yeah, and back when I started 1999 with Bright Trading. I mean, institutions weren't using algorithms like they do today. They weren't hiding their orders. If they wanted to buy the stock, they showed a big bid. If they wanted to sell the stock, they showed a big offer. And what you have is day traders out there seeing the big bid, and then, okay, well, if I can lean on that big bid for protection, if it's bidding 25 for 10,000 shares, I'll buy a couple hundred shares at 25 16ths. We've traded 16ths back then. I'll buy it at teeny up, we called it. That's 1/16 a teeny. I'll buy it at teeny up because I know in a worst case scenario, I can quickly hit the 25 bid and get out. So I kind of get like an easier look at the upside on that. And I mean, that still happens today. So obviously high frequency traders are doing this stuff in milliseconds. So the structure has changed dramatically from where it was 20 years ago, but the game is still the same. It's leaning on institutional orders for protection to a certain extent. Now, my trading is completely adjusted. I don't do any of that stuff anymore. But back then, you could almost think of, Bright Trading of a lot of our traders as like your original high frequency traders. We were looking, where is the institutional flow? And then just trying to basically trade ahead of the flow that we saw in the book. Reading the book, if there's a lot of buyers, on the bid, we're willing to buy the stock. If there's a lot of sellers on the offer, we would sell it short. So it was kind of like that.
That sounds like a massive advantage to have that and to understand that early
on. It was
on.
then. It's not now. Yeah. In 1999, it was for sure that reading the book, the level 2, we were living on the level 2, and then the turns in the market. We had Ben Lichtenstein. He would quote the S&Ps from the pit. So you'd hear all of a sudden the pit would turn and you roar, and you hear all of a sudden there's sellers in the market. Okay, well, that's going to start to hit the stocks too. There was a lag though. Back then, 1999, it took 6 seconds. Actually, when I first started, it was 8 seconds. So when you send an order on the New York Stock Exchange, you send it to the floor. It was 8 seconds before you got a confirm, and that was going directly to the specialist on the floor. NASDAQ was instantaneous because it was already using automation, but the New York Stock Exchange was using a physical person down there. Back in 1999 to send the orders back forth. So all of a sudden the market starts to go down in the pit. The New York Stock Exchange would lag a little bit, and we could take advantage of that lag time by selling short stocks that hadn't responded to the S&P futures movement. So early arbitrage is what it was. It was basically looking at the arbitrage, and we can trade SPY and Qs back then as well. But for the most part, we were just taking advantage of that there was a lag between the New York Stock Exchange and the S&P futures pit.
So how did you personally adapt when the market started to get more efficient and these lags disappeared?
This probably the first major adaptation for a lot of our traders and for myself was 2001 when we went to decimalization. because I think it was 2000 or 2001. I think it was 2001. So about a couple of years after I'd started, we were just coming out of the tech bubble burst, and a lot of our traders, were trading the 16ths, and all of a sudden you went from 16 pricing increments per handle. So for example, 25 and the 16ths, 25 eighths, 25 3/16ths, 25 and a quarter. There's 16 pricing increments in the 25 handle. Once you go to decimalization, there's 100 pricing increments. So what was happening early was you'd throw a 25.02 bid out there, somebody would go to hit you, and the specialist would buy it ahead of you at 25.03. They called it pennying. And we were getting stepped in front all the time on our orders. And actually, we lost a few traders back then that couldn't adjust to it. Now we figure out, different adaptations, and the specialists started to get in some trouble for doing that on the floor. So you started to see it not as prevalent. And then, you had a number of years up till 2006, 2007, where I was actually starting to run automation back in 2003, 2004. So again, we were taking advantage of little inefficiencies. I can remember doing like in 2003, 2004, I was trading JP Morgan, Chase Manhattan, doing risk arbitrage, Honeywell, GE. Also, I would do the Viacom A versus Viacom B. That was, I think, like 2004, 2005. And I was trading the VIA, VIAB almost exclusively there for a while. And at one point in time, I was doing almost 10% of the volume a day on VIA. So basically on the voting contract one. So basically, if you were buying or selling VIA in the year 2004, there was a 1 in 10 chance you bought or sold it from me. So, and all I was doing was taking advantage of the inefficiency that the VIAB would lead and the VIA lagged a little bit, and I would buy the one and sell short the other, especially on like an S&P futures movement or like at 2 o'clock when the Fed announced, or 2:15 it was back then when the Fed would announce interest rate decision. VIAB rips higher, I'd be trying to buy the VIA, and sometimes I would get it on for a really good price. I could buy the VIA scratch and VIAB up 50 cents on the day, and I'd just be pocketing 50 cents, put on the one, short the other, and then take it off and lag out of it as you will. But it was all just little inefficiencies that I was always trying to exploit, those inefficiencies where the stocks are not trading perfectly. But basically, if I look back to my entire 20-year trading career, yes, we're looking at, institutional orders and stuff and respecting that, but a lot of my other strategies were based on relationships. And those relationships being VIA, VIAB. You've got like the difference between VIA and VIAB is voting rates are on the VIA and the VIAB, and otherwise they're almost identical. So if I could ever buy the VIA less than the VIAB, I would always do it because I'm getting voting rights. And back then you didn't have to worry about as much about interest rates and borrows. It wasn't as difficult back then. Now they're a little bit tighter with all that stuff. So sometimes you'll see a VIA really blow out because the borrow became difficult. That never really happened much back in 2004.
What are your favorite market conditions to trade in?
Volatility right now. So for instance, when the VIX is spiking up to 70, 80, 90, I love that. The reason is that I'm primarily relationship-based inefficiency trader. So stocks all trade on their own, but they are all related to each other as well. Rob Friesen's done a great job teaching all of his traders over the years about pairs trading. We do that a lot. And what a pairs trade is basically is a relationship between Coke and Pepsi. There's a relationship between Delta and UAL. So Delta comes out with bad news, UAL is probably going to start to follow suit to a certain extent because they might speculate that they're going to have bad news. Some relationships are pretty much there, and then other relationships are constantly changing. But I'm still doing some risk arbitrage. Like for instance, I was trading Ameritrade. There's the deal on the table with Ameritrade and Schwab. I was trading that today. As the relationship gets a little bit out, I will buy one and sell short the other. And really what we're doing is just taking advantage of that inefficiency. If Ameritrade starts to tank, Schwab's going to follow suit because there's a merger on the table. These two stocks are linked together at this point in time through the risk arbitrage. So a trader that just says, no, I just want to get the hell out of Ameritrade may not be respecting that relationship at a certain point in time. And that's where a trader like myself will come in to bring that relationship back in line.
So it sounds like that's your dominant strategy, that your go-to play, the
relationships.
Yeah.
Yes. If you were just to throw me, what kind of trader are you? As people say, oh, I'm a chartist. People say I'm a fundamentalist. I am a relationship-based trader. I make my money based on relationships.
How long have you been trading for up to this day?
I've been with Bright Trading now for 20, going on 21 years. So it's been a long time. I started May of 1999. I guess actually next month will be my 21st anniversary. So I hope Rob's going to plan me a birthday party there. or an anniversary party for my 21st, no, I'm just joking, but 21st anniversary there. Bright Trading would be, I believe, May 5th of 2020. So I've been with Bright a long time. Again, I've seen, you know, I traded in the office, I believe, until 2013. And then I've been trading from home for the last six and a half years. So it's been a while now. We closed Detroit office, and obviously we went, you know, through, we've closed a lot of the offices for Bright Trading now simply because people do it from home. And now with COVID, I actually feel like I was the most prepared for, you know, something like this, because I've been working from home for a number of years. Really, my day-to-day daily routine is very similar. The weekends are a little different, but, you know, Monday through Friday, the kids are bouncing around a lot more, which is a little bit interesting. But for the most part, a lot of my day is the same as it was even before the lockdown.
From your experience from being with Bright Trading over these years, what is the biggest ingredient you see in a person to become a successful trader?
100% discipline. So what you'll see is a lot of traders get themselves into trouble, and they don't know how to work themselves out of trouble. You know, on any given day, I might make 50 trades, 100 trades. Maybe on a really crazy day, I might be making 200 trades. So, you know, we're trading quite a bit. So inevitably, you're going to get yourself in trouble every single day. You can't be right 100% of the time. So you've got to learn how to work yourself out of trouble. Again, what I see, and you know, I've seen this through the years, is the traders that aren't willing to take a loss that will struggle in this business and usually blow out their account very quickly. Traders that add to losers, okay, it's got to come back, you know. Well, when it doesn't have to do anything. The markets can stay irrational much longer than you can stay solvent, famous saying. It applies to day trading more than anything, because obviously we're using, you know, a significant amount of, you know, the company's capital when we're trading. So we have to be very protective. So the number one thing, I enter a trade not thinking about how much money I can make. I enter the trade thinking about how much money I can lose. I am really a risk manager. I put my capital at work when I see the risk relatively low, or I see myself a potential out. But always enter the trade having a contingency plan. What are you going to do if this trade starts to go against you? You know what I'm going to do? I'm going to be getting out. And you know, when you're doing relationship-based trading and inefficiency trading, you know, you've got to give it a little bit in the decimal world, but for the most part, a lot of these trades start working out in your favor, you know, very quickly. Usually, you know, when you're on the right side of the trade, because you start making money. You're on the wrong side of the trade when you start losing money. And just because, you know, a stock, you know, or even a pair blows out, doesn't mean it can't continue to blow out. And obviously that can lead to significant losses if you're seeing that move and saying it's got to come back. So the number one thing is to be able to admit when you are wrong and be disciplined enough to exit the position for a small loss before it becomes a big loss.
So regarding that, what was your most memorable trade then?
There's been a lot of them. If I look back, and this was probably a swing trade, so I do all my day trading with Bright Trading. All my short-term trading is Bright Trading, but I do some longer-term swing trading too. I have an interactive broker's account. Sometimes I do some longer-term, like I'm making a call on this where I think this is going to happen, potentially to happen. And I can remember during the financial crisis, this was before it started happening. You started seeing, you know, this was 2007, and you started seeing it start to get ugly. The market's starting to get ugly. And I had a few really good trades back then, but I can remember Bear Stearns had fallen from about $80 to $50. But the preferred stock of Bear Stearns was still sitting at par at 25. And basically, you know, these things just don't, you know, back before 2007, a lot of times, you know, it's just interest rates have moved them around a little bit, but a 50-cent move for preferred stock would have been a big move. But I can remember looking and saying, it's not probable that Bear Stearns goes down, but it's possible. And I can short this preferred at par right now for a 6% dividend. That's really what I'm going to be paying. You know, and again, back in 2007, there wasn't as much interest rate. Now you got to look, okay, well, what's the cost to borrow? Sometimes these borrows can be really expensive. It wasn't as much an issue in 2007. So I shorted a bunch of that Bear Stearns preferred stock around the $25, right around par. And 3 weeks later, Bear Stearns started to collapse, and the market started to collapse. And that Bear Stearns preferred stock, which hadn't moved, you know, it probably hadn't moved $1, you know, in years, fell 50%. I got it way too soon. I'm always one that enters positions very well, and I get it way too soon. But I can remember I shorted a huge chunk of stock, and I was covering at $21, $20, and you know, you're making like 20, 25% on a huge amount of money. in the course of 3 weeks, and that was really good trade. You can say, oh, well, what's 20%, but it was the call. It was like that. There really wasn't much risk, and the return was really high. So I've had trades where I made 20% in 5 minutes. And those are good trades too. But this was like limited risk. And so the risk reward on that would just be out of this world, because the risk on that was really just that 6% dividend over time, because it probably wasn't going to rip up to 25.5 or 26 because it had never really done that before. So the risk reward setup on that was just so good. And I had a few other trades like that too, where I was shorting preferred stocks of banks early. And me and my friend Chris Banier, we were doing that, and we made a lot of money. And 2008 was my best year. And we were doing a lot of short preferreds back then. But then we were doing preferred arbitrage as well. So it even got crazier. Once they started, you started seeing preferreds just trade all over the place. I can remember buying some Citigroup preferreds down to $5. I remember a bunch of these Citigroup preferreds closed at 12, and we were gapping down. It was a huge down day for the markets. The markets were gapping down 6-7%, and they were just selling everything. And I can remember buying one Citigroup preferred at $5 and selling an equivalent one short at 10. And just basically right at the open, and basically just making the 5-point difference, because these two preferreds usually traded in tandem together. And literally within 20 minutes, they were right back to where they were. They were both trading at like $8 each. So you make 3 points on the one, a $5 stock making 3 points on it in 10 minutes. You're talking about 60% in 10 minutes, and then short on the other side. So again, just taking advantage of the inefficiency that preferreds were mispriced relative to each other.
Yeah, that's an insane gain for that time frame. I guess that's why the markets right now are very similar to the 08 crash. It's really interesting the way the markets are behaving right now, because I don't know if there's do you see this turning into a real financial crisis?
I've said, and obviously I'm on the pre-market prep show for Benzinga. You can listen to that at premarket.benzinga.com. I've said this on this show quite a few times. We're definitely not out of the woods. And we could potentially, it is on the table that we could potentially be going into financial crisis part 2. It has potential at this time. It's not probable, kind of like the Bear Stearns collide back in 2007. It wasn't probable at the time, but it's possible. And it is possible that we could go into financial crisis part 2. What would it take? It would take it would take reopening the economy, and then all of a sudden we reopen it too soon and everybody starts getting sick again and they have to close it back down. Because if they have to close it back down, we're going to be closed down for a long time, potentially until we get that vaccine. So right now we know Georgia's opening, Texas, we're getting the beaches open in Florida. We're starting to get some stuff open. So it's going to be very interesting to see how the spread goes. Are they opening it too soon? I kind of feel like they are, and I'm kind of nervous about this. But the economy is obviously a concern for politicians as well. They're balancing the politicians are balancing lives against the economy. At this time, with the lockdown, you can't have both. They're hoping with their opening that they can have both, that people aren't going to continue to get sick, and we can slowly reopen, maybe using, some methods, people wearing masks, staying 6 feet apart, certain businesses. So that could help. But in a worst case scenario where it doesn't help and the spread starts again, and businesses have to stay locked down and shut down for a prolonged period of time, then you start seeing airlines not doing well or potentially failing. You could see, obviously, we have an oil crisis already. I don't know if we're going to get away from that, but small businesses, and not being able, restaurants, not doing. You could see so many sectors that could potentially be in trouble. That eventually could come and start to hit the financial system as well. If you have enough bad loans on your book, we know JP Morgan, Wells Fargo raising their loan loss provisions at this time. They're doing that for a reason, because they know there's some rocky roads ahead. The question is, how rocky is it? And nobody knows the answer to that question, but I own very few bank stocks in my long-term investment portfolio right now. The reason for that is that this is potentially on the table for financial crisis part 2. I mean, really, when you look, how did we get out of financial crisis part 1? We threw money at the problem. We kicked the can down the road. Now we're at, a situation where we're trying to throw money at the problem again. We know the Fed is trying to throw money at the problem again. The question is, is this virus, it was easy to fix back in 2008. It was a financial problem. This is a health problem. So it's slightly different. You can't just throw money at COVID and it goes away. Yes, you can throw money at creating a vaccine. Yes, you can throw money at creating a therapy. We obviously hope some of these therapies and some of these vaccines or a vaccine will eventually come out. But in the short run, you know, it takes time. You know, money will help, but it takes time to fix those problems. So right now, the Fed is band-aiding all of these small businesses by providing liquidity, providing capital to some of these businesses, trying to cushion the blow as much as it can until we get the virus under control. If that takes a long time, well, then you definitely could potentially see some of the banks get into trouble, and it could lead to financial crisis.
Yeah, it's crazy what's going on right now, and the uncertainty does create amazing market conditions if you know what you're doing in the markets, especially as a relationship-based trader.
Well, it is. As an inefficiency trader, I had my best month in March that I've had in 10 years. And that's just because the VIX is higher. As the VIX goes up, and a person specializing in relationships and inefficiency and statistical arbitrage is going to make more money. Virtue Financial, the high frequency trader, is probably making more money right now. They said, you know, on their last earnings that they were doing really well. I mean, the stock has done well too, VIRT. So any trader that trades inefficiencies is likely to make more money when the VIX is at 80 than it is at 12. Yeah. When it's at 12.
So do you personally use stop losses?
I use mental. I don't use physical stops. I don't throw, very seldom, unless I have a trade that I want to hold on and I think it's going my way and it's a swing trade and I've got to use something. Very seldom will I use a physical stop. I use mental stops. But again, I use discipline. So I'm not just going to let something get out of hand. If trade's not going my way, or if all of a sudden I'm in a trade and it gets bad news, I eat the loss and I move on. And you know, I've had instances. I was short Celgene. When it got taken over last year. I believe it was on January 2nd. January 3rd. It was January 2nd. I had a great first day of the year. I was like, this 2019 is going to be great. And then I Celgene short overnight. It was just a hedged trade. I was probably long some other biotech against it. And I'd been short from $65 from the previous night. And all of a sudden I looked in the pre-market and it's trading 80. And I'm like, 85, 90. I'm like, what the hell? And then you look and you're like, oh my goodness, it's getting taken over. And I'm on the wrong side. So I'm short the stock that is getting taken over. So some traders in that instance would be like, okay, well, I can't take a loss when I'm down 25 points on a $65 stock. And I'm just looking, how do I minimize the damage? So I ended up covering, I believe, at $86. The stock ended up going to 94 or 95 bucks. But, you know, so I ate a 21-point loss. And I did that probably all thought process in about a minute. Try to minimize the damage as much as you can. And you move on. And that wiped out probably a week's worth of my earnings because you had a stock literally get taken over. Here we are, you know, picking up, you know, nickels and dimes. And all of a sudden we got run over by the bulldozer. That can happen. That will happen. That's why you have to stay diversified in your trading portfolio as well. I never put all my eggs in one basket. If you've got a $100,000 account, I would never bet $200,000 on one stock because that can happen and that can blow out your account. If I had $100,000, I always say rough rule of thumb, maybe 5 to 10% of your in any given stock, but I stay diversified, not only my investment account and my trading account as well, just in case something like that happens. That's the first time I've ever had a stock, I believe, taken over on me. It might have, but where I've lost, to say like 50% in a matter of seconds. So it happens. So you've just got to stay diversified. And you know what? It was an ugly loss, but because I'm diversifying my trading portfolio, I recovered and I probably made that money back within 4 or 5 trading sessions.
So wrapping things up here, how has your trading career affected your life?
It affects your thinking. The way I analyze everything in my life, and I don't know if Rob, if it's the same way for you, but it's risk return. I look at, you know, what's the risk? What's the reward? And I analyze even normal decisions. And especially in this COVID environment, I'm actually one that I am like sitting, and me and my wife went into lockdown early before we were even mandated to do that. We had stocked up back in late February on groceries and everything because I didn't want to have to take on the risk of going to the grocery store. So it's all risk reward. So I analyze even the virus from that. I analyze, daily activities. Like I'm not a big fan of thrills. I would never do, skydiving because what if the parachute wouldn't open? I'm not a big fan of, even downhill skiing because what if I break my leg? It's probably a flaw in me that I'm overly cautious. And, you think naturally, like everybody thinks I'm a gambler because I'm a day trader. It's actually quite the opposite. I'm actually very conservative and I try to, minimize risk as much as I can. I'm a risk manager and I believe that's why I'm a successful trader, not that I'm a gambler. And I analyze everything in my life from risk management perspective. So, even with, the current conditions that we are, the financial crisis that we're, that I talked about, that scenario being potentially on the table. I was analyzing insurance and looking at your brokerage accounts, looking at, I've got a lot of my wealth with BMO Investor Line. I'm like, looking at individual accounts. And, if you read the CDIC insurance, we're in Canada, $100,000 is only in your checking account. The brokerage accounts go up to $1 million. So you got to analyze, and I actually have been moving money around to make sure that if it really got ugly and a bank collapsed, that I wouldn't lose any money. So that's how much, I'm a risk manager. I'm even analyzing it from that perspective as well. And I'm way ahead of this. We're not even close to financial crisis part 2, but there's no point to taking unnecessary risks at this time.
Well, just looking at things like that is a significant advantage over the average person anyways.
Just risk reward. I mean, and even to the little decisions, I like I said, I think I maybe overdo it sometimes, but I think it's a balance. Like every day you wake up, there's a risk, there's a risk you get in your car and you go for a drive. There's a risk to do this, there's a risk to do that. And obviously I'm not analyzing all those risks, but I'm cognizant of them too. So there's risk with everything, and everything is reward. So you've got to analyze those risks and make the best decision based on the risk reward profile, even in your day-to-day decisions. And I probably, if I wasn't a trader, I probably wouldn't analyze stuff like that.
So Rob, is there anything you'd like to add here?
Oh, I just appreciate listening to Dennis all the time. Love interacting with him. I'm really excited that he's been part of this whole journey and really applied himself in all aspects of trading, but also of serving the trading community by, trying to do anything that he can to help others, educate others, and also sort of lobby for us as traders and for our environment to be more of a, I would say, a level playing field, if it all can be. There's a lot of challenges in trading, from the more informed players versus the less informed players. But Dennis has done a good job trying to communicate, how to do what we can do, even though there's limitations, but really how to focus on, the things that we can. So I appreciate you guys doing this, Dennis. That was a generous amount of time, so thank you for that. Stephen, you did a good job with the questions, and I thought it was a real, very exciting, sort of fast-paced interview. Came out really well.
I talk too fast.
No, I mean, there was some energy. Yeah, good energy. It came out really, really well. So hold on one sec.
Well, thanks for having me, Rob. I appreciate it. And obviously, a lot of these strategies we've learned from you too. You've been a great mentor to me over the years too here.
Yeah.
Go ahead.
Okay. Well, thanks for joining us today, Dennis.
Thanks for having me. I really appreciate the opportunity.
All right. Thanks again. Bye. StockOdds is a stock market database and education platform. Visit stockodds.io for more information.